So I think we're ready to get started. This is the Small Business Direct Lending panel, so thank you all for coming. It's very interesting earlier, hearing about the whole consumer lending space. I was one of the guys who helped start Lending Club. I left them last year, and it's great to look at the platforms and how they've grown. It's interesting when you start to look at small business, though, because you're talking higher yields and shorter duration. So it's a great addition, and certainly you saw Renaud talk about adding small business or getting more small business going. These are guys that are up there right now doing that. Very interesting, too, in the lack of any real competition. I think a lot of people mentioned that earlier with what are called micro loans or less than $1 million loans in bank jargon, that there's not really that much competition. The banks aren't out there doing it. The addressable market looks to be about $200 to $400 billion. And while the banks, we heard from the meetings last week, say it's being served, the reality is there just aren't a lot of applications happening. So whether they're not seeing them or people are going for non-bank lenders, it's just not happening. Was doing some recent research just looking at the number of small businesses in America. And it's roughly 28 million firms that exist in the United States. But of those, only 20,000 have more than 500 employees. 1.2 million have more than 10 employees. So you're talking about a huge number of businesses with, 1 to 9 employees that really aren't getting served, particularly for loans of under $500,000, which tend to be working capital and inventory. The reason, as we've heard from people earlier and we'll get into, is that the banks just don't underwrite those loans well. It doesn't make sense for them financially. They don't have the right culture. They don't have the technical capability to get in and do that. And as I was talking to some of these people in the past week, what I learned and wasn't aware of is, from a regulatory standpoint, it's very difficult for them to even hold these loans on their books. So there are some real advantages that these platforms have that are challenging for the banks. So the people on this panel will address a large part of that market. And there's a lot of similarities to them. So it's new underwriting techniques, accessing a lot of old data sources. You can look at some of the bureau data, as weak as it is. New data sources, looking at cash flow, looking at other types of things like that. An online application process that is much faster and more efficient. So really improving that process flow for the small businesses. And they do play in very different segments, so we'll get into that, both in terms of loan size, but risk and reward. So we'll go through that. Let me introduce them quickly. We'll start with QuarterSpot, Adam. Adam's chairman and CEO of QuarterSpot. He previously was the CEO of a startup incubator, so he's helped about 10 different startups get to market. He also co-founded Unigo and was chief software developer for JetBlue. That was when JetBlue was actually kind of a neat company. They service small businesses less than $2 million in revenues, and they provide unsecured loans of $5,000 to $1 million. Instant underwriting based on cash flow, personal credit, and the terms are up to 12 months. Sam Graziano of Fundation. Sam is the founder and CEO of Fundation, which he started about 2 years ago. He launched it publicly last month. Prior to that, Sam spent about 10 years consulting Fortune 500 companies, primarily in banking, specialty finance, and asset. Graduated from Bucknell in computer science. And Fundation is an online lending platform that uses extensive data aggregation to render credit decisions. They offer small businesses debt capital of between $25,000 and $250,000 in 2-, 3-, and 4-year terms, and they target the mid-prime segment. They use a direct lending model funded by a variety of institutional investors. Endurance Lending Network, Alex. Alex is co-founder of Endurance, which he was inspired to build based on working within several franchise businesses. Extensive venture background, notably at Summit and running a Hasso-Plattner portfolio company. He worked in the U.S. Embassy in Paris and graduated from Stanford and Dartmouth. When I was talking to him earlier, I said, I've got a single sister. I think that's kind of perfect. He wasn't interested. Endurance is a lending platform that specializes in fully secured loans, so $1,000 to $500,000 at 3 to 5 year terms. 10.99% base rate, 3% origination fee, focuses on accredited investors. with a gross yield of 14%, returns of about 13%. So you can see these are higher yields than you were seeing in some of the other spaces. Noah is CEO of On Deck. He's been with On Deck since their founding, managing technology. He became the COO in 2011 and CEO last year. They offer 3 to 18-month loans of $5,000 to $250,000. And he's lent out about $500 million. Recently announced a very impressive investment from Google and Peter Thiel. So combine that with Goldman Sachs, and they're certainly the big dog in the room, and we'll do billions and billions, I think, in the near future. So thank you, panel. What we'll do is go down the panel, and what we'll do is start with each person's view of the addressable market, both in terms of customer requirements, the value of each segment, and how your product meets that need. So if we want to start with Noah.
Sure, happy to, and thanks, John, for organizing all this. The segment that On Deck goes after, you mentioned the 28 million small businesses nationally. The segment On Deck is focused on are the 7 million businesses that have at least one employee on payroll. So these are not hobby businesses. They're not always sole proprietors. They're LLCs. They're C Corps. They're businesses that have been around for a while. The average On Deck customer has actually been around about 10 years. So there's certainly sort of established businesses that have been underserved by the traditional market. We have two major value propositions that we're bringing to this segment. The first revolves around access. Traditionally, Main Street small businesses, restaurants, auto body shops, small manufacturers, retailers have very low approval rates at Main Street banks. There's a variety of reasons for that. I'm sure a lot of them have been discussed today. On Deck's approach uses alternative data, and whereas personal credit is sort of built up on negative information about how an individual borrows, On Deck's proprietary credit model, which is on its 4th generation now, is all about positive business information. We aggregate that information from dozens of different electronic data sources and compile that together to kind of make a unique credit decision in the market. And this model's now been proven through both a down economic cycle when On Deck started and now the current kind of level to up economic cycle. So access is the first part of our proposition, and speed and ease are kind of the second and the third. So a business owner can come to our website. They can get approved for up to a $35,000 loan in minutes. They can get approved for up to $250,000 in a couple hours and have the money wired into their bank account that same day. The average time to obtain a loan, based on data from McKinsey and Equifax from a traditional bank in the US, is about 30 days. So what you're seeing is a process that is not only being somewhat improved from a time frame point of view, but it's being improved by a factor of about 100. So the speed and ease we've found has opened up the market beyond these underserved kind of retailers and helped us expand into industries such as manufacturing and healthcare, where the business owners might be bankable, but they don't have the time to invest in that process with the bank. So access, speed, ease are kind of the core of what we do, and certainly the foundation on the company that the company's built on.
I feel like he just took pretty much everything I was going to say, but let me just... No, the reason I say that is because what we emphasize through our brand is simplicity and access, and we call it being a low friction process, and that's very important. The reason that's very important is if you think about a small business owner and you compare that to a lot of what you heard today about the consumer market. I think we spend most of the day talking about the consumer market. The consumers are much more willing to invest time and resources by trafficking online. They're heavier internet users. Small business owners, right? 85–90% of them are managing that business as a matter of lifestyle, meeting their income needs to support their family. I think the press and everything likes to romanticize about small businesses being this engine of growth. I mean, the fundamental issue is really that Google, Microsoft, big companies like that, they're the engine of growth for this economy. The small business economy is there to service those major industries, right? So a lot of the people that own these businesses, they own it because it meets their lifestyle needs, and they're very busy every day managing those businesses, right? So if you can offer them what we call a low friction process, it's a huge value proposition to them. So as we see where we fit in, certainly I think we're addressing a slightly different segment of the market than Noah is. I mean, we really see the market. I mean, it was kind of addressed a little bit earlier this morning. It's kind of like a barbell in a way. On one end of the barbell are companies, like On Deck, who's probably doing the best job of all of them, which is providing these businesses an opportunity to manage cash flow through a shorter duration product, a little bit higher cost, but they'll pay for that because you're giving them a very quick access to capital in small amounts to manage their cash flow needs. On the other end of the barbell is if you can get it and you're willing to go through the brain damage of it, you can go to a bank and you can get a very, very cheap cost of funds. But what we're finding is that we have also two different types of customers, right? One is those are looking purely for simplicity, and they're bankable. And we have an example of that already in our portfolio, which is someone was willing to pay us a premium rate because we made the process so much simpler than if they were going to go through an SBA process. And then the other end is people looking for access. And they're really some of the same industries that he mentioned already. I mean, a classic example is one of the ones in our portfolio was a liquor store who had been on a merchant cash advance product, but he had a very stable business. So we provided him an opportunity to improve his capital structure, but also give him some additional capital so he could launch a joint venture and improve his business and grow his business. So we really think about ourselves as, and you said it in the introduction, as filling the mid-prime sector. And what we mean by that is, a lot of the subprime companies typically end up in the merchant cash advance space, and obviously the super prime end up in the bank space. And despite what Mr. Sanborn said this morning, we're actually here and filling that gap, and that's what we're looking to do, is provide a slightly lower cost product than they would get in the merchant cash advance world, and giving them an opportunity to get an ROI on that capital by allowing to invest in their businesses over 2, 3, or 4 years.
So at the risk of agreeing too much, I think we all agree the market is very large and not served. I'll throw out a number, which is that CRA, Community Reinvestment Act, reporting organizations lent over $200 billion last year, or 2012. So that doesn't include non-reporting agencies. It doesn't include what I actually think is even more interesting, which is the shadow pipeline of people who are intimidated by banks or go in once and are told no for some checklist reason, and end up either not starting a business, not expanding their business, taking a loan from Uncle John, or just dipping into their retirement savings. And so when we look at the size, and we're talking about the scale here of how much this alternative lending is growing in the low billions now, and we're talking about a market that's hundreds of billions. So that's how I define it. In terms of how we're addressing it, we are looking at, I like to say that the loan that a bank should be doing, but isn't because of size. And I view that cutoff size as about $2 million, where a bank is no longer looking to, they may listen, but very unlikely to actually make a loan. People point to the SBA, which is guaranteeing loans, not making loans. And the SBA is only about 10% of that market size that I mentioned. So, when I think about it, and John mentioned that I got into this because I am a small business owner, I found that in my prior career as a private equity guy, raising hundreds of millions of dollars for harebrained schemes was something that banks were lining up out the door to do, but that it was a very humbling experience to be turned down over and over by commercial bankers for a $100,000 loan for our very profitable, growing, asset-backed, partner-backed, guarantee-backed, firstborn child guarantee-backed small business loan.
We all sort of play in the same game. So I'll repeat a lot of what was said if I bring you through a whole model. But we sort of look at it as the sort of mid-prime, also sort of subprime. I think we think of ourselves, our model, a lot like the model that got Capital One off the ground, which was you bring in best of breed underwriting team, risk modeling team, and you monetize a segment of the market through both underwriting and technique. To essentially address a portion of the market that isn't currently being addressed. And there are some guys on this panel who have more experience than us with it. But I think we're sort of looking to go after the business who is bankable or isn't bankable but will be bankable, and we want to grow with that business. So we want to take them on now when they're currently paying, let's say, a 70% rate or an 80% rate with their merchant cash advance company. We want to bring that cost of capital down a little bit for them, and as we work with them over time to further reduce their cost of capital, as we sort of build that performance record. Now, I think there's a massive opportunity in the market, just the cash advance market alone. Online lenders sort of play a similar game to offer these businesses lower rates, and to do that through by essentially charging interest the way you would in a standard consumer loan. So the way we actually structure our loans out, a cash advance company structures their loans, and they sort of calculate all the interest up front. So let's say you take out a $100,000 loan. They're gonna charge you $19,500 on top of that, and they structure it like a factoring transaction. You're buying, let's say that either buying your receivables, your next $119,500, and because that's calculated up front, the effective amortization in all of our models. I'm not sure about the endurance model, but it's sort of a straight pay down to zero. So these businesses actually end up paying, let's say double the interest that they would if these loans were structured like loans and they were amortized. So we try to reduce the cost of capital for the small business that doesn't have access to a bank product or an amortized product, and with that, we couple that with a lot of the other things the other guys have said. We try to offer fast access to capital. We try to underwrite in minutes, and it's about speed to dollar as well. For these companies, they need the money, they need it now.
So, when you look at what you guys can do, and your ability to offer a better process, instant underwriting, over time, banks will slowly start to narrow that. As I talked to a couple of you guys, I was really interested to understand how you were saying it was difficult for banks to even compete in the space. And just if one of you or two of you want to take this one in terms of, the Basel II challenge, the other regulatory challenges that banks have keeping small business loans on their books. So whoever.
Yeah, I mean, so the latter part of that question, I'll answer. And I think, John, we talked about this when we talked on the phone, which is, one of the very reasons why this is an opportunity is, I think of it kind of, two issues kind of combined, which is the regulatory influence and the collateral, right? So the U.S. is a service-based economy, right? So we're not a manufacturing-based economy anymore. So the majority of the businesses that do borrow are service-based companies. And by that definition, they don't have high-quality liquid collateral that they can pledge against the loan. So you have to be a lender, right, that's willing to lend based on the likelihood of default and be able to price based on the likelihood of default, right, to meet your returns. Because if a loan does go bad, I mean, the recovery rates, and you probably have more experience with this than anyone, given you've been around a lot longer and have data on this, the recovery rates are quite low. It's because you're legally secured, but functionally you're not as secured as you would be by a piece of real estate, right? So you have you have people in Washington say lend to small businesses, right? Then you have the OCC and the bank saying, wait a second, why isn't this file thick enough? And by the way, this loan has been on your books for 6 months. I don't see any updated financial statements on this, right? So that's the regulatory mindset. And if that's the mindset they're going to influence on the banks, it's very hard for them to do this type of lending because it's costly enough to get on the books to begin with, but then to administer it just because you need to get updated financial statements and whatnot just makes it all the more unprofitable for them. So it's just why that in the current state of affairs, this type of lending clearly belongs in the alternative lending sector.
Anyone want to add anything?
Yeah. So I was speaking to a Citi executive a few weeks ago, who I know through a personal relationship, and he's on the marketing side of the house, and they've looked at the segment and how they can get into it, and he just they wish they could tap in. The thing he said to me was, from a default perspective, it's very difficult for us to enter into the small business market because we look at it as, let's say, a 5% default. If we were to go after the market that, and On Deck was the example he used, if you go after the market that On Deck is using. For us, because that isn't, and I'm no bank regulatory expert, but the way it explained it, that's not a tier 1 asset, it's a tier 2 asset, and within the Basel requirements, the capital we have to keep on hand just makes it completely unattractive. Think about having to keep 6 or 7% or even 10% of the loan principal on hand for the term of the loan. To protect the shareholders' equity. I mean, as everyone knows, it's what Basel's about. It's about protecting the shareholders from leverage and the scenario where a bunch of the assets default. There's no capital reserves to protect those that default, and as a result, it directly hits shareholders' equity, and everybody loses out. We saw with Lehman Brothers. So So yeah, it's not just. I think there's a cultural issue, but then on top of that, there are regulatory challenges outside of just examiners. Being on top of them.
Absolutely. Hitting the other side of it in terms of sources of capital. The VCs that were up here earlier were talking about the fact that platforms are going to get better multiples than direct lenders. Direct lenders are certainly getting higher yields. What's better? Anyone who wants to take it?
I mean, to be determined, I guess.
So why did you choose, for the guys who are the direct lenders, why did you choose that, and how does it impact in terms of your choice in capital sources?
Part of having a platform is proving that you have the ability to basically source customers, underwrite and manage that risk, right? So you can't do that without capital, right? So what my firm did is we decided to bifurcate our capital structure from the get-go. So basically we could preserve the flexibility of our organization, still allowing us to charter our own destiny, because me and my friends right here that work with me didn't take a gigantic amount of dilution, right? I mean, we basically we raised capital at the operating company, which allowed us to build our technology, to pay our bills, et cetera, and then we raise a separate pool of capital, which once we book a loan, we sell to that vehicle, right? Which makes us a direct lending platform at the moment, but it means that we still have the flexibility to be purely a platform someday if that's what we decide to do and if that's the way the market evolves.
I'll jump in just because we are also a platform in endurance. I think that ultimately the reason why people believe that platforms might get higher multiples is because there are powerful network effects associated with it over time, giving access to many people in this room and at the conference generally, the ability to get access to an asset class that hasn't been available to them in the past is a very powerful idea. And that's not to say or discredit a balance sheet lender. But one of the other reasons I like the platform is that we have the flexibility also to, we don't want to disrupt, you can't change everything in one day. And so there are a lot of people who want to participate in a more traditional way. And by using a vehicle that allows us to have many SPVs associated with our platform, we can bring on investors who want to have a more traditional warehouse line structure, if that's what appeals to them, and look like a balance sheet lender in that capacity, while at the same time building over time the network effects that are associated with a marketplace.
Yeah, I would just add, I mean, I think back over the 6 years of On Deck, and the two questions I've been asked probably more than anything are, are these specialty finance companies or technology companies? And then the other one is, platform versus direct lender. And I guess, on the first one, I do think finally that distinction is becoming a little bit less. Is Amazon a retailer or a technology company? They're in the retail business. They use technology to make it awesome. We are in the financial services business. We use technology to make it awesome. So I think that's the right analogy, and hopefully people can sort of move beyond the sort of semantics argument there. I think the discussion of direct lender versus marketplace is more interesting. And the way we think about it On Deck is when we started, we were using totally proprietary and kind of esoteric means to underwrite these businesses. And I think the difference between us and the peer-to-peer lenders is what the peer-to-peer lenders have done essentially is move a bunch of consumer balances from Capital One to Lending Club and Prosper, which is mildly interesting from an economic point of view, and the consumer saves a little bit of money. What we are doing is fundamentally enabling access to capital for a series of folks who have not had access before, and we're using very different means to assess the creditworthiness of these borrowers. You gotta put your money where your mouth is, full stop. So, esoteric means of underwriting, proprietary technology, it meant we had to put our money where our mouth is, and guess what? 5 years later, we have a track record, we have a credit score, and what we're seeing now, the dynamic, the fact that this conference even exists, is evidence of the fact that investors are now willing to back non-traditional means of assessing creditworthiness and are willing to take more of that risk. So I see a continuum, and that's where we play, frankly, today. We have a set of assets that we produce every month or every week or every day where investors take the credit risk. We have another set of things that we do where On Deck takes more of that credit risk. So I guess I would sort of encourage people to, again, move beyond the duality mode. I think what you're going to see in these companies is sort of a blurring of that line between the direct lender and the marketplace, and that's the right answer, I think, because what you don't want is a bunch of investors getting screwed investing in a bunch of new platforms that have no track record, no credit worthiness or whatever, you need to make sure that those folks have some skin in the game. On the flip side, when those companies get to scale and prove out their models, you do want to leverage the network effects and the benefits of diversification. So anyway, that's how we see it.
But I mean, at the end of the day, right? I mean, I think we're also saying what matters most, right, is where are the deep pockets of capital? How do they want to play, right? I mean, we spend a lot of time. I mean, there's been a lot of talk today about the retail marketplace model. I mean, that's nice and all, right? But I mean, that's not where the real large sources of capital are, right? And you ultimately need to make, if you want to be a large-scale player, your business model needs to be able to accommodate, either owning the assets outright in the format that the institutions want, right, or creating a marketplace in a format that the institutions want, because that's the only way to really build a very large-scale organization. I mean, fundamentally, as I think about the whole space, right, I mean, whether you call it direct lending, whether you call it peer-to-peer, whatever you call it, I mean, all you're really talking about is separating the lending infrastructure from the balance sheet, right? And those that can run a infrastructure the most efficient, right, and get the best assets are going to ultimately win, right? Now, that's sometimes why I ask myself, and why I kind of decided not to create a marketplace, because I said, it's hard enough to find the good customers and to predict and manage credit. Why do I want all the other problems with creating a marketplace? And I think that's why, I mean, we decided that we picked the business model that we've chosen.
We're kind of, we've set ourselves up to be a hybrid as well. One of the when we think about leverage and as a startup going out to get leverage in order to be able to sort of invest ourselves, you get yourself into a position very quickly where you have banking covenants that are starting to control your underwriting policies. I mean, if you're going to a bank, they're going to require you to have all of the same sort of unattractive terms that a bank loan would have. And so we do want to differentiate ourselves, and as a result, we've gone the route of supplying in sort of a non-leveraged scenario. I can't really go into it in detail, obviously because of Regulation D. But the point being, I agree with the guys. It's much easier. The peer-to-peer models, you have to manage large groups of individuals. You have to do a large group of sale. It's a small dollar amount. It's not. If we can go and sell an institution and bring $10-20 million in, that's 200 people, 300 people that you got to bring to the platform. It's a much easier model to get off the ground. The way we look at it is we don't want to get ourselves into a scenario where we've got a bank covenant that doesn't allow us to get overextended in an industry, or that doesn't allow us to work with a specific client because they've grown too big. We don't want those types of constraints in place, and so we've tried to work around that.
So as you guys look at the loan sizes that you have, I mean, it's very impressive to me that you could go to a platform and get a $500,000 loan. As you look at the underwriting relative to that, as you look at the other challenges that you have, do you identify certain segments? Are there different things that you're looking for? What's the characteristic of one of those really large loans versus, the average loan, is probably 30 to 50 across the platforms probably. How do you manage that difference in terms of efficiency as well as what your customers are looking for?
I'll take. I mean, so one of the the value propositions that we think we offer to an institutional balance sheet provider is, we think about people, process, and technology, right? So, I mean, our process, I mean, it's really designed to be a hybrid underwriting model for a hybrid asset class, right? So, the smaller the business, right, the more intertwined the financial success of that individual is with the business itself, right? So you have to look at both consumer-oriented data and business-oriented data, right? But as you start doing larger loans, one of the issues is obviously, the larger the loan, the more it hurts if you get it wrong, right? And as good as the data sources are, and by the way, we integrate 12 different products into our technology platform, none of them are perfect, right? So what we've designed is, I have two senior credit people, right? One who runs automation analytics, and one who sets credit policy and manages the judgmental part of our business. So by the time a customer comes off of our platform, we've screened it with 12 different products. We've run our business logic, across all those different products. We've segmented the risk. We've run it down different decision trees, whatever. and then we've rated it, and then we have a chance to look at our underwriting screens and say, you know what, yeah, we like this one, we'll do it. Or we need to supplement the data, right? But the whole idea is it's light touch, right? Which is, if you compare that to what a bank does, right? Obviously, we've talked about it all day. I mean, you go into the bank, they say, give me all these documents. And most of the time, the customer's thin file, so they're going to hand you a tax return, right? And even that doesn't tell you that much, right? So what we do is we use the technology to aggregate thousands of different data points, right, on the business owner and the business, to be able to give us that actionable data. And actually, I think the data is even better than if you went through a manual document collection process. But then we override a light touch judgmental process to make sure that we're making the right decision at the end of the day. Over time, as we grow our business, the thicker the file that you can get on a business, the more likely you are able to automate it, and that's how I think you ultimately scale. But right now, we feel like the hybrid underwriting model, given the quality of the data sources, is really the right approach for this market.
Cool. Anything to add?
We also have a hybrid underwriting model in the sense that we are doing larger loans than John mentioned. We do up to $500,000 size loans, and again, it's because we are trying to do the loan that we think the bank should be doing at meaningful level, and so that presents challenges because we won't be able to iterate our data as quickly as some others. We can't afford to have as high loss rates, and so we have to rely on some outside data. That said, we are one of the only people that are going after this type of customer and gathering the data on it, and so think that over time our model will become more and more predictive, and that others will not have built out that capability. We do. How do we adjust for it? The fact that it is so meaningful if we did have a loss, and the answer is that the market is so dislocated that the credit qualities of our loans are actually extremely strong, and so the model is more in a learning mode and a screening mode as we continue to iterate on it, and eventually we'll have better and better or tighter standard errors on it. But in terms of where it ends up looking like, we look at how many times asset coverage does this thing have? What would have to happen for this thing to go wrong? And so having that human to be able to act as a credit committee type of yes/no at the end is very, we think, sensible. And you can have some human involvement at $500,000. There's a lot of fat in that loan. There's a lot of fee in that loan. And so we don't need to eliminate him right away. Over time, we hope it becomes human by exception, and then eventually completely score-based is our vision.
So, and we deal with the problem. Our transaction model within it enables us to spread risk across our funding sources. So it fractionalizes the loan on the back end. So we might have a $500,000 loan that's actually a $100,000 loan between 5 funding sources, right? So we're able to spread risk that way. But we look at it as, at the portfolio level, you need to sort of spread yourself. And if you're only doing daily repayment and you're only doing retail, you're only doing it in this region, something like Sandy's going to hit you, right? And your portfolio is going to get hammered. In order to get into the larger businesses, larger loans, they're not going to go for daily repayments. You kind of have to get into the monthly installment, and that's when we get out sort of the year basis. In some cases, we'll do lump sum. But the point being, it's really how you spread the risk and how you build the portfolio and how you pass that portfolio along to our investors on the back end of our platform. So by offering some product that's upwards of 30% return, and then some product that's down in the 10s and 12s, we can balance it and after default get them a return upwards of 20%.
Right. Noah, given that you're at roughly $500 million in loans, you had the company operating through the credit crisis. What does it look like to you now versus when you first went through the door?
That's an interesting question. It was a fun time to start a lending business in 2007, I think, and some of you in the room were partners with us on that journey. I'll never forget where I was when I saw the first customer miss the first payment and kind of what the email said. How do I put it? I have strong opinions on this, I think, from that experience. And it's sort of this, and I think it's an interesting tension point between the folks on the panel. So the question is, do plain vanilla product structures offer lenders enough protection during down market cycles? So I will tell everyone in this room that our ass was saved in 2008, 2009, not because we were geniuses at underwriting, but because we had a product structure that allowed us, within 3 months of making a loan, or a vintage of loans, to evaluate the performance of that vintage, course correct, make adjustments. And so I think there's an interesting tension point, I think, in the way these companies go to market where, how much does that product structure need to resemble a bank loan? And we'll put it all on the table. It has to be about rate, the frequency of collection, are the collections automated, the term of the loan. I would argue that the reason why banks are sort of push-pull in small business lending is because they don't have product structures that protect them in the different market cycles. So I think where OnDeck looks different to me today is, one, I think the structural hypothesis we had has proven itself out. In 6 years of lending, that's 24 static pools on a quarterly vintage basis that we've been able to analyze, refine, and iterate on in our credit model. And then the flip of it is now we're way, way, way better at assessing obligor risk, right? Which small business is, given identical product structures, which one is more likely to default than the one next door? And so today it's about structural risk in the way you structure your products, and it's also about obligor risk in the credit modeling you use. I think that's what's different about OnDeck today is we do both. But frankly, in the beginning, if it hadn't been for the structural protections we had in our product, I might not be on the panel with these guys.
I wouldn't say I feel the tension. Right. So, I mean, he brings up an interesting point, right? Which is, our product is actually an amortizing term loan just over a slightly longer period of time, right? So while he may get his money back in 5-6 months, our average duration will be a year and a half, right? But that's not the whole story for us, right? So what we did before we ever decided to put our platform in the market is we spent, and my partner over here sitting over here is responsible for this, thousands of hours of research into the quantitative and qualitative success factors of every industry code of significance, meaning there's 100 of the 1,100 industries in the small business market, 100 of them are actually extensive borrowers, and of them, 40 of them are just horrendous from a credit profile perspective. We studied all 60 of them, and we looked at things like why do they borrow, what do they typically borrow for, right? What are the vintages right across before, post, and after the cycle look like in terms of loss rates and all of that? And that type of thinking informed both our strategy around which customers we want to drive to us, but also it's also embedded in our technology as well, where we can apply, we call them like filters or whatever you want to call it, modifiers to their risk rating that's based on that knowledge. So we fully looked at that, we understood that before we ever designed a product or we ever developed a technology platform.
Only had a couple minutes left. Let me see if there's any questions that we can go to in the audience. Sure.
Especially for Noah. Do you consider designing products that will make them easier to securitize and access to capital markets?
So the question was to Noah in terms of, do you consider products that are easier to securitize so that you can access, I guess, larger capital markets?
Yeah, I think the short answer is absolutely. I think the point was made earlier. Why do people go to Costco? Because it's cheaper to buy in bulk. So the bigger you get, the more cheaply you are able to access capital, and the more I think it is incumbent upon the originators and credit platforms like us to design structures that work. We think it's about the diversification of strategies here. Some direct lending, some of the other elements like capital market securitization, we think are going to be important parts going forward.
Just to build on that, I think there are a lot of, and our internal structure is set up to enable us to sort of raise capital in a variety of different ways. One of the things we haven't seen yet with the peer-to-peer guys, which I think is entirely possible, and I also I believe it could be a massive pipeline of liquidity for businesses like ours, for businesses like the peer-to-peer companies, are exchange traded notes like ETFs. So we're kind of looking at ways now how in the future, on the flip side of our platform and the leverage side of the platform, if you will, how we can sort of package that stuff up, put it in a trust, roll it into a trust, get it a ticker symbol, put it on the public markets. I think there are a lot of sort of innovative ways that you can go about it, and I think we'll start seeing more of them in the coming years.
Cool. Why don't we go to one last question for the panel, if each of you, can answer, which, is always the one I love to ask, which is, what's your favorite loan story, in terms of the loan that you gave that made you feel good, or that, you knew you were really doing something that was helping businesses? Whatever order you want to go.
I gave a couple of mine before. Even though a liquor store isn't exactly the one you want to give to everyone, but no, but it really changed it changed his outlook on his business and, his income, right? He had a more challenging capital structure than he deserved, given his skills to manage his business and the resiliency of his business. And at the same time, he couldn't get any more capital, and he had a joint venture opportunity that would actually expand his income as well. We were exactly that type of lender that he was looking for, that would, give him a product that he deserved, where he was able to improve his cash flow, but also, buy some discounted inventory and get a joint venture started where he is actually able to, increase his income, his take-home pay, by at least 30%.
Go ahead.
So I don't put this in our book because people don't really believe it, even though it's one of my favorite loans, and there's a bunch of stories like it. But we have one borrower, and could name a few, that have unbelievable levels of asset, and this one in particular is a salad restaurant in San Francisco that I'm sure a lot of people would know, that has 8 locations in that one brand and 3 locations in another. He has a $4 million house that I've seen, and a securities account that's I'd be happy to have. And so, and that guy couldn't access bank financing. And so, that's not necessarily the do-good of the world. He's obviously very well heeled, but I think it speaks to the amount of dysfunction and how we are narrowing that very wide gap. And we talk in consumer about consumer lending and how there's this wide gap between credit card charge-offs and the charge-off rate. And I look at that and I think that's a pretty narrow gap as compared to what we see in the business world. And so as I look at that loan and others like it, where another one had 7 properties that they could pledge as collateral, and I think of Noah's question about cyclical downturns and how are we protected. And the one thing we haven't mentioned is that we do secured lending, which is something that's different, and there is protection behind it. Those are my favorite stories to tell, even though I can't credibly put them in a deck because nobody believes me.
We're funding a loan today, actually, which is a loan to a New York business owner, and he had gone a couple of places to try to get capital, a bank, and then ended up with getting approved by a merchant cash advance company, and he wasn't really smart enough, or it's not that smart enough, he's just not educated on amortization and how the whole thing works. And we worked out we're getting off the ground, so we still have a personal relationship. We're not quite the size of an on deck yet, and so our chief operating officer is sitting in the office in the audience. He sort of helped him through the numbers and helped him see that the loan that he was getting was actually 78% interest rate. And we were able to offer him a rate at under 40%. It was a 38% rate. So the $100,000 loan, on the $100,000 loan, he ended up saving about $10,000, which is money he can reinvest back into his business, to hire people to grow his business. And so he was very appreciative of that.
For me, one that comes to mind, first of all, I don't think it matters how big you are. Your job is to know your customers at any scale, and so I actually get copied on every single customer survey that comes through, and we have a very high Net Promoter Score, right up there with like Apple and Southwest and Amazon, and 93% of our customers recommend us. But when one of those comes through that doesn't look good, I fire off an email to the person who's responsible and ask them what the hell happened on this deal. So I do think that service, we didn't talk about it much, is a huge part of what we're all trying to do here. The customer that comes to mind, we have a program called Shop on Deck where employees get rebated when they shop at our customers. And so one of the customers is a fried chicken restaurant downtown called Dirty Bird Fried Chicken. This is the guy who came to the office and actually spoke to our team at one point. And 5 years in business, profitable, single location, independent business owner. It's great fried chicken. And his direct quote was, "I went to a bunch of banks and I got no love from the banks." And so he wanted to open a second location, and so he took 2 on-deck loans over the course of about 9 months, and got that second location open and employs 12 people. And he's doing great, and that location's now doing well, and he's thinking about a third. So that's a very representative story. I think business owners take our loans. The best use of our capital is when you have a clear purpose for it. There's a clear return on investment. And I think for all these companies, that's the opportunity. And ultimately, it's all about stimulating economic growth. That's why we're here and why we're fired up about what we're doing.
Cool. Noah, Adam, Alex, Sam, thank you very much.
Thank you.